Okay, so I get excited about this chapter because this is definitely a chapter in my wheelhouse, which is cash and financial investments for chapter 10. So I look forward to doing this with you. So we talk about the sources and nature of cash. And before we even get started on this, I just want to talk to you about cash in general. Cash in general is not traceable the way everything else is. So if you, for example, if you leave a big pile of checks outside on your front porch open with a bunch of ballpoint pens and you leave them out there and then somebody goes and steals them and writes a bunch of checks against your account, you could call the bank and you could say, stop, someone stole my checks. Um, I want to stop payment on these. I want to protect my account. If you leave a big pile of cash on the front door step and it's all the money you have in the bank and you leave it out there, you cannot do anything. The cash is gone. No one will ever know who stole it. Maybe you take a video, but once they spend the cash will be gone. And so cash represents, in the world of internal control, one of the weakest and most important areas of observation for an auditor, both internal and external audit. It's a very weak spot, so it must constantly be treated with the uppermost discretion and also concern and care. So let's talk about the nature and sources of cash. You get your basic general checking account. Checking accounts are, for the most part, considered cash. Um, Payroll checking accounts, petty cash, actual cash on hand, and then you have savings accounts and cash equivalents, money market, certificates of deposit, and savings certificates. So another area that they didn't talk about, and as we move to a more credit card world, is cash that you deposit from your cash register. So again, it represents a weak spot. So again, we call our checking accounts cash. They exist on the balance sheet as cash. So as we refer to our checking account for the rest of this particular lecture, we'll be calling it cash, not to confuse anybody. All right, so we look at the inherent risk of the environment, including fraud related to cash. We look at the type of business it is. Is it a check cashing firm? Is it a place that carries very little cash and or spendable cash, not checking account? Checking account. There's very little with regards to checks and cash, and we use that to frame the environment that we're going to be operating in to test. Then once we go in and do that, we look at the internal control over the cash. Is the cash locked? Are the checks locked? Who has access to them? Who has authorization to write them? How often is it being reconciled? So once we get a feel for the internal control, then we look at the risks and material misstatement and design the controls and substantive procedures to look at the existence of recorded cash and occurrence of related transactions. And then we look at the accuracy of the transaction, the completeness of the cash. And then here's a very important part, verifying the cutoff and accuracy of the transactions and whether or not the client even has right to the cash. And then, of course, presentation and disclosure, including restricted funds, like if you're working with the government. Now, the cash typically has a smaller balance. So a lot of people are like, well, it's a small balance account, so why are we devoting so much time to looking at this small balance? And one of the reasons is they want to justify all the things that flow through the cash. So liabilities, revenues, and other assets go through the cash account, the checking account. The other thing is it's very tempting for misappropriation of asset. It's a high risk account. Even with the checking and the traceable nature of checks, in many cases, once it's out the door, it's out the door. So we look at the organizational structure, the org chart, and we look to see that the cash is recorded and immediately deposited, that there's a separation of powers, or a separation of duties regarding the cash account, and that things are made timely and dispersed, and whoever's authorized has been properly done that, has been authorized to make those disbursements, and that the balances are maintained at adequate but not excessive levels. We don't need to have an excessive amount of cash. So here it is. This is it. And it's so simple, and yet it's so hard. And this is the spot that I see over and over again replayed. You do not permit one employee to handle a transaction from beginning to end, no matter whether or not they're your sister's brother's cousin, no matter whether or not they're your best friend, no matter whether or not that employee has been working there for 30 years and you just started as a junior accountant the last week. It does not matter. You do not permit one employee to handle the transaction from beginning to end. Just don't do it. You separate the cash handling from record keeping. The person that handles the cash should not be making the deposits. So that is why at the end of the night, they hand you a slip of register receipt, usually kind of a white paper tape, and you take that tape and you take all the transactions and you reconcile the cash drawer and find out where mistakes might have happened. You centralize the receiving of cash to any extent possible. So if you're getting deposits, it goes through one central area. It doesn't go into different departments. And you record cash receipts on a timely basis. So I could tell stories here. You know, I'll just take this moment for a story because our other slide was kind of short. So I worked at a bank, and I was doing loan work for a customer, and I went out to their branch. The guy was in some sort of tile business and hired someone to work as an administrator, and the administrator got off work at 5 every day, was required to go to the bank to make the deposit. The administrator did not like the traffic and chose to hold the deposits for one trip per week instead of fulfilling the nightly duty. And we pulled a cash account, caught that, and realized that this particular administrator had all the checks stuffed behind the what's that thing that covers the oh my goodness, I gotta pause for a second to figure out what that thing is called. Sorry for the mystery. Stuffed behind the visor of their car, like $100,000 worth of checks stuffed behind the visor of their car. So of course the owner fired this administrator, and we encouraged the owner to do all their check deposits online. So at the time we were just starting with the online check deposits. This was kind of early 2000s. So my point is that stuff happens. So you also want to check receipts and totals cash register. So I'll get off that story. Everything involving cash must be done quickly, including depositing checks, and then you need to have the person that prepares the bank recs not issuing checks or taking custody of cash. Now, there is a way you can do this if you are a small business, and I highly recommend if you're dealing with a small business, if you have someone that's the owner that comes into the bank every single day, that owner should make the deposits. And I worked for an owner that did this. The only time that the owner didn't make deposits is when he went on vacation, and then I made the deposits. And technically, I would have been the one person that reconciled everything, but that's what happened. So, okay, so let's look at internal control over cash receipts. Again, more than one employee, make sure that they're not in cahoots, because that happens too. And you want to go in and check the custody. Now, let's talk about receivables, because receivables is the same thing. Receivables, remember, if you're working in a sales situation, receivables can be created to book sales revenue. I say creative, normally there would be a delivery of product and that sort of thing. But in a financial fraud situation, I've seen this many times, where receivables are created, sales are booked, receivables are later written off after sales commissions have been paid. And so, and what happened, or if someone's trying to make some sort of financial goals and they hit their receivables. So the thing that you would want to look at is making sure that the receivables are actually exist. The other thing that happens, sales are booked, product is delivered, and then of course the customer was a fake customer, and the fraudulent person keeps the product, and then eventually the receivable is written off. So that's another way that assets can be misappropriated. So there's a lot of looks. That's why when you do those substantive test receivables, you go in, you call the customers, you check the sales, you check the accounts payable, you actually go in and try to get verification of that, because of those reasons. That's a big area of fraud. People don't realize how much fraud can roll through receivables. All right, so here's the look at a flow chart of the cash receipts. It's a little small on my chart, so I encourage you to go in and take a look at it yourself. You can see here, looking at the flow of things, you can find areas of weakness if you're doing an audit just by looking at the flow chart. You can kind of go in and see how things are and look for the spots that might be potential areas of concern. Again, I can't talk about that segregation of good duties enough, and it costs money to do that. The other thing you can do is outsource some of that by using an off area person to do your QuickBooks or your reconciliation. And those people are so easy to hire now. In 2020, things have changed a lot. So you have that opportunity out there, and I would definitely take advantage of it. The other thing that they talk about is pre-numbered checks, because people can copy a check. It's very easy to get the paper to do now, and then continue to write checks off of your account that have no number and steal money from your account in that particular way, or steal actual checks themselves and forge out what they want, signing it, and so on and so forth. I cannot tell you how many episodes of, I think I made you watch Forensic Files. I think I've got you doing that one week, where you find out somebody who works for somebody else has been writing checks to cash to themselves. No one in the accounting position should ever write a check to cash. Ever. Period. If you get your reconciliation up and you're an owner and you see a check made out to cash, you should immediately have all your red flags up and potentially call that person in. To me, that would almost be a fireable offense. An accountant, a payroll administrator, a person that writes checks or is responsible for cutting checks should never have a check made out to cash. That's a big red flag. The owner themselves should not have checks made out to cash. It's just a no-no. The other thing is when the person signs off on the check and you have a check package, for example, you've got purchase order, you've got the list from receiving, documents have been received, and so on and so forth. And you've got your little package of everything that went on when you get ready to cut the check to the vendor. You should go in and cancel all the documents and show that they've been received and mark them out so that somebody else can't take them and get a check cut that shouldn't be should be cut. And then obviously there's things about the mail that are very important. We don't think of the mail as being very important, especially in 2020, but things come into the mail that, particularly if you're a small branch, you get someone who brings in the mail every day. The person that is the check signer should mail the checks. Why should they not hand it off to someone else? Because the person that is the other person may go in and wash the check or change the amounts or make it out to themselves or cash or forge it or whatnot. This is very easy to do. So the check signer should walk that second step, not hand it to reception, actually drop it off with the mail person or the post office. Also, the person that opens the mail should not be anyone in accounting. There should be a separate person open the mail. Why? Because if somebody's cheating, the late notices are going to come through the mail. Okay, so I'm going to pass this flow chart and talk about the risk assessment for the audit of cash. You have to understand the possibility that you may miss something, and again, looking back at the internal control will be the amount of substantive procedures that you choose to enact. And then they look at the different types of misstatements. And this is kind of an interesting one. Recording fictitious cash receipts. That would be overstating the cash receipts by transferring them out to between bank accounts to without appropriate recording of the transfer to cover up an embezzlement. So for example, if you come in and you're kiting checks between two accounts because you've taken some money out of an account, we'll talk about kiting later on. The weakness is lack of segregation of duties. So as an auditor, you walk in, you see one person doing everything, one person that's been there for 30 years and brings brownies on Friday. Then you have a lack of segregation of duties that you have to test. Now, is this person that's been there for 30 years and bringing brownies on Friday a crook? No. But you have a lack of internal control, and so what's going to motivate your client to be better is the fact that they're going to have to pay for all the substantive testing. Failing to record receipts from cash sales. So some people, you've been to a McDonald's or a fast food restaurant where there's a sign. I saw one. I remember I'm from Florida, not originally from Oregon. I'm a transplant, but one of the things that there's a big problem was people would sell the food, the hamburger that you go through the drive-through to get, salad, whatever, and then just put the cash in their pocket instead of running it through the machine. So that's a failure to record a cash receipt, and another way to embezzle. So that comes from inadequate supervision. The other one is failing to record a collection from accounts receivable and then subsequently writing them off. And I think I kind of discussed that earlier with you. And then there's cutoff problems. So for example, holding cash receipts open to record next year's cash receipts, or having that occurred in this year. So the idea of inappropriate cutoff is usually when somebody is trying to make some sort of sales goal and they're trying to make some sort of earnings goal. So again, you're going to want to look at the board of directors and the tone at the top, and you're going to look at how quickly they get to the bank and record cash receipts. All right, and then of course here's some more on cash disbursement. I encourage you to read through these. Just going to see if there's anything interesting in there. All right, additional tests of controls. You're going to go in, and one of the ways they do is called reperformance. where you go in and you rework the reconciliation and you reperform some of the accounting functions to see if it jives with what you had originally, with what they had done, if you match that person. You can also pull a sample of cash receipts and look and see if everything lines up through the process. The journal, the AR postings, the deposit slips, just follow the cash cycle. And then if you see something loose or something that's not correct, then you can always revise the risk of material misstatement by lowering your detection risk. All right, I'm not going to read through all the substantive procedures. You could do that in your book, but I would highly encourage you to do this. And then I wanted to talk to you about the standard confirmation of deposit accounts. So I actually had an opportunity. There's actually a program now if you're trying to substantiate deposit accounts where you can go on a universal program and it works with all the different banks. And it's a computer program. You pull it up, you get certain authorization from the customer. The customer gets a code, the bank gets a code, you get a code, everybody's approved, and everybody runs through, and you can quick verify the confirmations of deposits. It's really super cool, and it can be performed electronically. The old-fashioned way is to go in and actually mail out the standard confirmation and then hope you get it back. And if you don't get the confirmation back, then you have to call the person and ask them really nicely if they will do it for you. And usually if they have a good administrative staff and they're a strong customer, they will. Believe it or not, most people do it. It's kind of cool. Actually worked in this department in the auditing, so I know all about it. Most people are pretty nice. They're just busy. Everybody's busy. All right. So again, proof of cash. Let's talk about kiting. So back in the olden days, which is the 90s, back in the 90s, it took about 3 to 5 days for a check to clear. So there was no debit cards. There was none of that. Everybody wrote checks. People bounced checks, right, left. Banks made tons of money on bouncing checks. But one of the things you could do is you could open up a checking account and you could deposit some money into it. And then you could write a few checks off of it, pull the money out, and then go put it somewhere else. And then basically move the money around as you were writing and use it to write more checks. So kiting is used so much in fraud. Most of the time when you go on the corporate greed show, American Greed, 9 times out of 10, the scheme is some sort of kiting related item. Whether they take the investor's money and they use it to spend it on something else and then try to fool the investors by opening a different account. There, so much. Is this kind of like a Ponzi scheme in many ways? By bringing in new people, you're just kind of kiting the money across. So Check 21 cut that out. Check clearing is a lot faster than it was in the early and late 90s, but it's actually really hard to kite. It's not as easy as it used to be. But there's other ways you can do it. And we still kind of keep an eye on the bank transfer, especially around the holidays. But Check 21 really trimmed that down. Data analytics is great to pull things. One of the beauties of data analytics is you can almost pull all of the sample. Used to not be able to do that. It also helps you pull out things just basically by looking at the data, and you can find things that are outliers. Like for example, you found a few employees that have a large expense reimbursement. Right here, like this one right here. This is a great example of how you wouldn't be able to see that unless you were charting it out. So you can just pull records and see duplicate payments, improper disbursements. I mean, it's really nice that everything is electronic now. Okay, let's talk really quickly about what financial instruments are, switching gears. Marketable securities, which is what you know of, stock market, treasury instruments, commercial papers, mortgages, cash surrender of insurance policy, and derivatives, which is something we'll have a lot of fun talking about in advanced accounting. So you have to have a specialized knowledge to audit financial investments. And so the one that's a really hard one to do is securities and derivatives. Those are really hard, particularly when you're dealing with companies that are partially owned. That is probably like the one where if you want to be the super auditor, that's like the hard stuff. That's like the NFL, the NBA of auditing right here. This is a hard job to do. It takes a lot of mathematical knowledge, the barriers to entry, but it's a very exciting job if you're doing it. And you do have a lot of computer technology to dig through. And then, of course, the objectives of auditing financial instruments are about the same as everything else. And you can see the kind of the pattern here: obtain an understanding, assess inherent risk, obtain an understanding, and then assess the risk of material misstatements, and design substantive procedures. So same thing we've been doing all along. And then the control over financial instruments is really going to be driven by the board of directors. Some people have a separate finance person that does this job. Some people incorporate it into their accounting department. All right, so here are the potential misstatements that you can run into. Theft of marketable securities. So there are certain items that are kind of a risk item, like a bearer bond is one of them. Probably not as easy to steal marketable securities as it used to be because everything is so computerized. A lot of it might come from unauthorized transactions or improper. This is another one: improper valuation of investments. A lot of problems with mark to market, which is assessing investments at their fair value, or at their market value. And then failure to properly account for derivatives. It's just hard to do derivatives as they are, so it's really hard to account for them. And then disclosure is another weak spot because of disclosures. And if you go in and look at the back of a 10K, you'll see where there's forward-looking and different disclosures at the back. You look at oil and gas, it's just like you need to go and get a college degree in oil and gas just to dig through those financials. Those derivatives are pretty intense. So definitely something you got to look at. Now, looking at the evaluating the test of controls. If you find that once you test the controls, then you can go in and revise the material misstatement. And then here's a list of the substantive procedures. All right. And I'll let you look at these. Final thoughts. Cash account is super important. It really drives the tone of the audit. So be aware of things that, one of the things we run into in this class is, unlike our previous classes, auditing has a softer component to it, that you have to go into a firm and you have to look at someone that might be there for 30 years and assess the fact that risk of control, control risks are there. The other thing is just understanding the nature of things like accounts receivable and the weaknesses that go out anytime a payment is made. There's some sort of exposure, and understanding how you can mitigate that. So And for those of you who are interested in learning more about derivatives, we will probably see each other in MBA Corporate Finance, and we'll have lots of talks about it there, as well as discussing it in advanced accounting. So that's one of my favorite classes to teach. So anyway, hope you're having a great week and appreciate your time today. Take care.